in parts 1, 2, and 3, we built Jim's world. Jim owns 100 million ounces of silver. He hedges with 20,000 short futures contracts. He survives price swings. He survives volatility. He survives margin pressure. But there is one thing Jim cannot hedge: exchange authority. To understand that, we need to talk about nickel. In 2022, nickel prices exploded higher. Short sellers were under extreme pressure. Margin calls cascaded. Liquidity thinned. The market became disorderly. Then the London Metal Exchange halted trading. After that, they canceled executed trades. Billions of dollars in profits and losses were erased. Legally, the market was effectively rewound. Many traders believed they had made life-changing gains. Those gains disappeared. Now here is the uncomfortable part. If nickel had collapsed instead of exploded higher, there would have been no cancellation. There would have been no rewind. There would have been no reset. Intervention occurred when the move threatened systemic stability, not when traders were losing money. That asymmetry matters. Exchanges do not exist to protect your trade. They exist to protect clearing stability. If margin stress threatens brokers, clearing members, or settlement integrity, the exchange has authority under its rulebook to intervene. They can raise margin aggressively. They can halt trading. They can modify settlement mechanics. They can encourage cash settlement. They can adjust delivery terms, all within the legal framework of the exchange. Now bring this back to Jim. Jim owns physical silver. He hedges with paper contracts. If silver gaps violently higher and margin stress spreads across the system, Jim's short hedge comes under pressure. If margin requirements change overnight, Jim must post capital immediately. If settlement mechanics shift, Jim must adapt. Jim can hedge price. Jim cannot hedge rule changes. That is the boundary condition of paper markets. This does not mean silver trades will be canceled. Silver is deeper and more liquid than nickel. But nickel proved something important. When stress exceeds tolerance, price discovery can become secondary. System stability comes first. Now think about leverage. Futures traders operate entirely inside exchange rules. Physical metal does not receive margin calls. Mining companies do not depend on exchange enforcement to exist. Exploration companies own assets in the ground. Highly leveraged paper traders depend completely on the rulebook. Nickel demonstrated that the rulebook is active. And in extreme conditions, outcomes can change. The lesson is not fear, the lesson is structure. If you are trading silver with leverage, understand the boundary. If you are holding physical metal or equity in real assets, you are operating in a different layer of the system. That distinction matters in stress environments, not financial advice, educational purposes only.